The headlines are terrifying: war, global tension, and a bear market that feels like it's never going to end. Most investors are looking at their portfolios and seeing a sea. They are panic selling and they're losing sleep. But there is a group of investors who are not just surviving this, they are actually thriving. While the world feels like it's falling apart, their bank accounts are still receiving notifications your dividend has been deposited. Today, we are going to look at the Ironclad strategy. We're going through the history books through the 1940s, the 1970s, and the 2008 crash to explain exactly how a successful dividend investor stays the course during war and bear. First, we need to talk about what actually drives stock market returns. In a bull market, everyone cares about price. But in a bear market or during periods of war, prices can stay flat for a decade. If we look at the 1940s, during World War II, the S&P 500 had a total return of about 10%, but 67% of that came from dividends. In the 1970s, a decade defined by high inflation and war, dividends accounted for a massive 73% of total returns. Even in the last decade, in the 2000s, price returns were actually negative, but dividends kept the total return positive. When the price part of the equation breaks, the income part becomes your lifeline. Successful investors don't look at their portfolio values as much as they look at their annual income. If the market drops 20% but your income stays the same or grows, you have not actually lost your lifestyle. Not all dividend stocks are created equal. In a bear market, you don't want yield traps, companies paying 10% because their business is failing. You want the dividend aristocrat. Historically, dividend aristocrats, companies that have raised their payout for 20 consecutive years or more, outperform the S&P 500 in down years by an average of over 13%. Why? Because these companies have wide moats. Whether there is a war or a recession, people still need medicine, people still need to eat, and people still need to heat their homes. The strategy is to focus on free cash flow. If a company earns more cash than it spends it can keep paying you even if the world is in chaos. This is the most important part. The biggest enemy in a bear market isn't the economy, it's your own brain. When a growth stock drops 50%, you have nothing to show for it but a loss on a screen. But when a dividend growth stock drops 50%, the dividend yield doubles for every new dollar you put in. Successful investors use the pay-to-wait mentality. Think of a bear market as a sale on future income. Getting that quarterly check provides the psychological feedback you need to stay invested. It proves the business is still alive and functioning, even if the stock ticker is down. So, how do you handle your portfolio right now? First, reinvest automatically. In a bear market, your dividends are buying shares at the bottom. This is the ultimate buy low. Second, check the payout ratio. Make sure the company is only paying out a safe percentage of earnings, usually under 6% for most industries. This ensures the dividend won't be cut if earnings temporarily dip. Third, diversify geographically. Don't just own one country. Look at international dividend ETFs to hedge against local conflicts and currency fluctuations. Wars and bear markets are scary, but they are also the periods where the greatest wealth is built. The ironclad investor knows that while prices are volatile. If you found this helpful, check out the list of 5 dividend aristocrats and one in this volatility in the description below. Which dividend stock has been your rock during this recent market dip? Let me know in the comments section. Don't forget to hit the like and subscribe to keep your income growing, and I will see you in the next one. Bye.